Let's be real for a second. You hear all this noise about trading. Buy this, sell that. Watch the news every damn second. Most people think they're gonna get rich by chasing some hot tip they heard on TV. That's a total trap, man. It's a one-way ticket to a world of stress. And it's the fastest way to blow up your account. It's designed to make you lose. But what if I told you there's a simple, almost hidden strategy that cuts right through all that crap? It's something 90% of traders completely ignore. It's not about being a genius. It's about not being an idiot. This thing works. It works when the market is going crazy, and it works when it's dead calm. It doesn't matter if you're a total beginner just starting out, or if you've been in the game for years, losing your shirt. The secret isn't some complicated algorithm that only a math professor could figure out. It's simple, it's powerful, and the big dogs on Wall Street, they don't want you to know it. Why? Because when you trade smart, when you trade with a plan, you stop feeding them your money. So here's the biggest myth out there, the one that absolutely guts most traders. People believe trading is all about speed. You gotta be the first one in, you gotta be the fastest to react to the news. You have to be glued to your screen, making 100 trades a day, scalping tiny profits. It sounds exciting, right? It feels like you're in the action, like you're a high-frequency trading wizard from a movie. But this idea that more trades and faster decisions equal more money, it's a complete and total lie. It's a myth that Wall Street loves because it makes you trade more and pay them more fees. Why is this myth so wrong? Let me tell you a quick story. I know a guy, super smart dude, who got into day trading. He was convinced he could outthink the market. He'd wake up, chug a pot of coffee, just start firing off trades based on tiny little wiggles on a 1-minute chart. He'd make a few bucks here, lose a few there. He was busy. He was stressed out of his mind. At the end of the month, he looked at his statement. After all that chaos, all that adrenaline, he was down $2,000. He was trading on pure emotion, reacting to every flicker of the screen. Alright, let's get into the meat of it. The strategy is so simple. I call it pattern positioning. This isn't some black box trading robot or a get-rich-quick gimmick. It's a framework for your brain. It's a simple checklist that forces you to be disciplined. It's built on 3 pillars, and you need to use them on every single trade, no exceptions. The pillars are rules, size, patience. That's it. These 3 ideas are your shield. They protect you from your own worst enemy in trading, your emotions. They make your decisions mechanical and clear, which is exactly what you want. Step 1 is the most important. Rules first. Before you even think about clicking the buy button, you need to write down your rules on paper or in a document. Get them out of your head and into the real world. Your rules define exactly when you will enter a trade and when you will exit. Use concrete numbers, not vague ideas. For instance, a rule could be, I will buy a stock only when its price closes above its 50-day moving average. Or, I will sell immediately if the price drops 3% from where I bought it. These are your non-negotiable laws. Step 2 is just as critical. Size smart. Decide before the trade exactly how much you're willing to lose if you're wrong. A very common and effective rule is to risk only 1%. Let's make this concrete with a simple real-world example. Meet Anna. Anna's new to this and she's got a $2,000 trading account. She's not trying to get rich overnight. She's trying to build a skill. She decides to use the pattern positioning strategy. Her first rule is size smart. She will risk 1% of her account per trade. 1% of $2,000 is $20. That is the maximum she can lose on any single trade. This immediately takes a huge amount of pressure off her shoulders. She knows she can survive being wrong. Next, Anna defines her entry rule. Her rule is, I will buy a stock when it breaks above a clear resistance level and closes there for the day. She finds a stock, let's call it XYZ, that has been stuck at $50 for weeks. One day it closes at $50.50. This triggers her rule. She buys the stock. Her exit rule is, I will place a stop loss order 4% below my entry price. So she places her stop at $48.48. If she's wrong and the price drops, she automatically sells and loses just about $20. Her risk is defined and controlled. Now for the patience part. Anna doesn't sit there staring at the screen, sweating every little tick. She has a plan for taking profits, Maybe a trading stop that moves up as the price moves in her favor. She lets the trade work. The stock moves up to $55. She moves her stop loss up to $52, locking in some profit. Now, it's a risk-free trade. The worst that can happen is she makes a small profit. She's letting her winner run while her risk was strictly capped from the very beginning. Over time, she just repeats this process.